the idea behind what I'm going to discuss is just touch upon some of the basics of accounting. But if you want to learn more, I can give you kind of tools and ways that you can learn more. So just know that I'm trying to give you very much a basic kind of sense of what financial accounting is, but it's not going to be, obviously very comprehensive at all because we only have so much time in a day. The other piece that we're going to talk about is building budgets. Okay, and so the two types of, major accounting rules there are GASB, which is Governmental Accounting Standards Board. So obviously in the school district, that's what we're using. Or if you are the city, right, that's what you're going to use, right? So basically that's GASB. There's differences there, there's different rules, different procedures, etc. FASB is Financial Accounting Standards Board. So like if you've heard of SEC, anyone heard of SEC? Security Exchange Commission. So any publicly traded stock in the NASDAQ, S&P 500, any ringing a bell here? Okay, those. So when you go to New York City and you see the bull, like those guys, that's FASB. They use Financial Accounting Standards Board rules. So in the example, I think you guys got a printout of.
Okay, yes, I forgot.
Oh, okay. So the example that you don't have a printout of, it's online.
Yes.
Oh, okay. So if you download it online, there's an example of I forgot. I think it's called Central Valley Health Network. So that example is FASB. Okay. That's not a governmental accounting standards board financial statements. It's using the FASB rules. Okay. The two things we're going to talk about, there's all kinds of financial statements and stuff like that. There's a 12K, there's an 8K, there's a cash balance statements. There's all kinds. It'll make your head spin, right? All the different statements you can review and understand. I'm going to keep it simple because I don't want to overwhelm you. And we're going to just talk about two different statements. We're going to talk about the balance sheet, which is a snapshot in time. That's why I put a little camera there. Do you remember? It's basically like a snapshot. Boom. What's in your statement? So if you went to your personal account for your checking account, right, and you took a snapshot of that, that's basically it. Like, this is how much I have right now. Okay. Then there's income statement, right? And an income statement is basically your statement of profit and loss over an interval of time. So from X to Y, right, what has happened in between that time period? Make sense? So this is kind of the definition. I think I got it from Investopedia. But the definition for a balance sheet is a financial statement that summarizes a company's assets, liabilities, and shareholder equity at a specific point in time. Okay, that's really important. It's a snapshot. These three balance sheet segments give investors an idea as to what the company owns and owes, as well as the amount invested by shareholders, right? So the FASB accounting the reason they created this was because, hey, if you got a bunch of money, right, and we're publicly traded, right? I'm not sure if Central Valley Health Network is publicly traded. I don't think so. But all these publicly traded companies, in order for an analyst or investor to figure out, well, which one should I invest in, right? FASB was created to make sure everyone's following the same rules for all those statements. So anyone can basically look at those statements and analyze and determine whether or not they want to invest in company A, company B, company C, right? That's the idea behind, these rules and being consistent. So the balance sheet is probably one of the most important statements you can look at, in my opinion, when trying to study and understand the viability of a company. So I want to play this little mini video we found. It's only a minute long, but it gives a brief overview of balance sheet.
A balance sheet is a statement of net worth. It's broken up into three sections: assets, liabilities, and equity. A equals L plus E. Meet Joe, Joe goes to the bank and gets a small business loan. The bank gives him cash. On the balance sheet, his liabilities increase by the size of the loan and his assets increase by the same amount. The balance sheet remains in balance. Joe uses the cash to buy a truck and start his own pizza delivery service. His cash assets decrease, but that's balanced by an increase in his other assets, a new truck. As Joe delivers pizza, the profits are recorded in the balance sheet as retained earnings in the equity section of the balance sheet. The cash from his profit is recorded in the assets section, balancing out. Every month, Joe makes a payment against his loan. He reduces his liabilities by the amount of the payment, and his cash is reduced by the same amount. To find out his business's worth, Joe subtracts liabilities from his assets. This equals the net worth of his business.
All right, so that was a quick little video overview of a balance sheet. And what I want to do before I jump into a few of my problem set examples and stuff like that is I want to talk about the 3 segments of a balance sheet. So Emma, you have those cards, right? I'm gonna ask a question and you're gonna give the card out. So we got some little prizes because I know how exciting, right, financial accounting is. So does someone want to raise their hand and tell me what are the 3 areas of a balance sheet? The video talked about them. I wrote 1 on the board, so there's a clue. So really, it's just you need to really just say 2 of them.
Assets, liability, and is that right? No.
Should I get? Does someone else want to? Maybe you might be the closest. Someone else want to try?
Assets, liability, and loans?
No.
Assets, liability, assets minus liability equals net worth.
It's very close. You said equity. There's a word before equity. I'm going to give it to you because you're so close. Shareholder equity.
Oh.
Shareholder equity. But you're really close. So basically what we have is assets, and I'm going to write that here. Liabilities. Okay. And then we have the shareholder equity, which I'll put over here. Okay. So let's start off with assets, because I think assets is the most easiest thing to explain. Based on that video that kind of gave you a little tidbit of what an asset is, anyone want to raise their hand? This isn't for, I don't have that many cards. This is just, what are your thoughts of what's an example of an asset?
Cash.
Exactly, cash. Property is a good example. Anything you own, yeah, property is a good example. Anyone else? Think about like you, right? What is something that you own that's a specific example of an asset? A car? Okay, yep. All right. A home? I'm just going to put something here. Property. All right. Any other examples? You guys?
Stocks and stocks.
Yeah. Yeah, that's an asset. All right. So other things that I'll put down is inventory. So that could be if you're a manufacturer of a car business, you'd say cars are my inventory, right? So it would be, it'd be an inventory of cars. But if you're not in the car business, right, but you're a let's say you own a pest control company and you have a couple of vehicles, that would just be an asset. It wouldn't be your inventory because you're not selling it, or it's not being in it. It's not an asset that's being replenished, right, and recycled, right? But if you are in the car business, a car would be your inventory. Same with homes, right? If you're Granville, your inventory is all the new homes, right, that you're trying to sell. But if you're just a regular, business or whatever, and you have your commercial property is your long-term asset that you use, right, to work out of, right? Does that make sense? So there's different types of assets. Other assets I'm going to write down in here is accounts receivable. Has anyone ever heard that terminology? I'm sure Inez. Okay. So would one of you want to define what accounts receivable is? I hear crickets.
Don't look at me.
Well, it's not a trick question, right? Accounts receivable, the name kind of describes it, right? So I'll define it in a very quick way. An accounts receivable is something that you believe you will receive in the future, basically. So, for example, if I gave Inez my phone, right, my iPhone 6, say, hey, here you go. And then Inez says, hey, tomorrow I'm going to give you $100 for that tomorrow. That's an accounts receivable, right? That's something that I'm going to get in the future, but I'll put that as an asset, even though I gave you my phone, and technically you could probably be like, I'm not giving him anything. But I believe you did. It's the belief, right? It's the belief that you are going to give me my money eventually, right? So that's an accounts receivable, okay? Here's another one. This is my favorite one. And I'm going to get into politics on this one, unfortunately. So this is called goodwill. Anyone know what this is? Anyone want to take a guess what it is if I said I'm going to get into politics describing this? That's a good guess because it's called goodwill. It's not that connected, no. But it is in a way. I get why they call it goodwill. All right, I'm gonna tell you what it is. So, let's say I decided I wanted to start a business selling cars, right? And I call it the Ilori Mobile, right? So I'm gonna sell these Ilori Mobiles. And I say, I've sold like one car last year. So now I think my business is worth $100 million, right? So I can say that because of my brand, the Ilori Mobile, I can sell more cars. And therefore, that's an asset. Does that make sense? So therefore, I'm going to put that under goodwill, that I have a $100 million asset of my brand called the Ilori Mobile, right? It's very controversial, but FASB allows you to do it. So you have people in all kinds of different industries and stuff like that claim and say that my brand, like Nike is a big brand, right? You got that swoosh, you can charge hundreds of dollars for a shoe, right? And so Nike, in their balance sheet, I guarantee you, I haven't pulled it up recently, but I guarantee you there's going to be a goodwill. And that goodwill is going to be upwards of 100 million or so, easily, right? Because they're saying their brand is worth something. And maybe they're right? The problem with that is it could be worth that much today. How do you write down goodwill? It's hard to quantify what it truly is because it's a make-believe number. So the reason I'm going to get into politics is because Donald Trump, who's running for president, right? Everyone says, he's not worth what he is, or he's saying he's worth more, right? The whole reason for it isn't because of the fact that no one understands what his assets are and liabilities. It's because of this, right? Goodwill. It's because he's saying the Trump brand is worth so much because if I put a Trump on anything, it'll sell. That's basically what his claim is. But other people are saying, well, I don't think your Trump brand is worth that much, right? So there's a swing of $3 billion or that he's worth all the way up to $12 billion, right? It's a big swing, and everyone's like, how does that make any sense? But it's because of goodwill, right? It's because we allow this in financial accounting, right? And it's basically, I personally think it should be booted out because it's like there's no way to truly quantify that. I think it's difficult. And you get it, in my opinion, when you sell things, right? So when your accounts receivables is high and your cash is high, it's kind of captured, in my opinion. So that's why I don't agree with it. But hey, that's what it is, and I wanted to make sure you know. That's how our accounting rules work. So that's assets. Another thing you want to understand about accounting is that there's two different ways to make a change in assets, right? You can do a debit and you can do a credit, right? Is anyone familiar with this language, debits and credits, right? There's a sigh. So assets is like kind of, one part of the balance sheet, right? So let's say, for example, Heather, right? Is there a Heather? Heather, okay, sorry. Let's say, for example, Heather, we have a company, right? And this time we're selling ice cream, and we sold $100 worth of ice cream, right? So, and we received that cash. We received the $100 of ice cream, we sold it today, and we received the cash. We would increase our assets, right, by the cash of $100, right? So we would do a debit of $100, right? So here I'm going to do this T, which in accounting, can you see? Is it two? Okay. So we got debit here and credit. Okay. So this would be a debit of cash of $100 if we sold $100 worth of ice cream. But it cost us in inventory, right, to make that ice cream. Let's say it only cost us $10. Okay. So what we would do is we would credit our inventory by 10. Okay. And we do inventory. Okay. So a credit in assets, it's reducing, right, the asset. And a debit is increasing the asset, right? And then that difference, well, people say, okay, if you're getting $100 and it only costs you 10, then there's $90, right, that you made, that profit. Where does that go? I'll talk about that later, but that goes in shareholder equity over there. But the point that I'm trying to make is that a debit in the asset column of the balance sheet is an increase, right? And a credit is a decrease in the asset column. And I think who told me the equation? Inez, I think you were trying to do it. You guys were. So an asset, right, minus liabilities. Let me put the equation up here. Assets minus liabilities is equal to, I'm going to do SE for shareholder equity, okay? Is equal to shareholder equity. That's the equation. It has to balance. That's why I love accounting. Because it's like, it makes sense, right? It just has to balance. It can't be different. So assets minus liabilities equals shareholder equity. That's why that $90 has to go somewhere and it has to balance. And it has to balance in shareholder equity, right? That's how much, really your value of your company. Make sense? Okay, cool. So now, does it make sense why a debit is an increase in assets and a credit is a decrease in assets? Does that make sense to you? It's just a rule, right? It's just, you kind of just memorize it. It'll make more sense when I explain liabilities and shareholder equity. All right? So that's what I'm going to talk about for assets. Everyone good with assets, or do you want me? You have questions about assets? Okay, cool. So let's go into liabilities. All right. Anyone want to give me some examples of what you think a liability may be? Wait, what did you? Cost? Like what? Like when you say cost, give me an example.
Well, in my line of work, I think liability is like you get injured, that affects the company, and now they have to, I don't know, I think like.
And so if you get injured, is it like a workers' comp claim or?
Yeah.
And how much does that cost the company in premiums?
Yeah, like they just basically tell us like where you have meetings all the time about liability, and basically if we don't get hurt, they reward us.
Yeah,
Like,
yeah.
You know, so you don't get hurt, they'll reward us.
So I'm going to write here basically premium costs for insurance and other claims, right? The cost that you as a company you have to pay that, right? Whatever it is.
Would it be a loss, like a loss fee?
It could be that if let's say someone actually gets injured, but just to get that policy right, it costs some money, right? That's the in effect the liability, right? The cost that you have. So I'll say something like insurance premiums, right? Okay. Any other examples? Good example. Loans. All right. So I'm going to go back to you, Inez. The example that I gave you where I said, hey, I'm going to give you my phone. You give me $100, but you promised me you're going to give it to me tomorrow, right? On your balance sheet, how will that look like? An asset or a liability for what you owe me?
For what I owe you?
It's
Yeah.
Gonna look like, if I owe it to you, it's gonna be a credit.
Mm-hmm.
And
A credit on
it'll be a credit against my assets.
once you give me the cash.
Yes.
Yeah, but until then, how do you balance your books? It's a tough question. I'm going to give you a card if you get it, because it's a tough question. How would you balance your books? So I'm not going to give you the answer, because I think if you're going through the problem solving, you guys are getting your brains going.
I'm gonna have the phone,
Okay.
giving you the $100.
And you're giving me the $100. So you're increasing your $100.
Yes, I'm increasing my assets right now.
Yeah, with the $100 value of the inventory of my phone. So you'll get 100. This will be a plus 100. We'll call it phone just so it's simple, right? So the value of the phone is $100, right? And then this is a phone.
But then I'm decreasing.
What are you going to decrease?
I'm decreasing my assets because I'm actually paying you.
But you haven't paid me yet. Remember, this is a snapshot.
Oh, okay. So right now,
So where does the other $100 go?
well, the other $100.
Think about a liability.
Oh, so it's gonna go. Yeah, no, I don't know about that one.
This is a tough one. So basically what's going on is this. When you accept this agreement we made, remember this is a snapshot in time, right? I gave you my phone, you got it? You promised me tomorrow you're going to give me the $100, right? So that means you're going to increase your inventory by 100, right? But you're going to also increase your liability as an IOU. You're going to owe me, basically, it's going to be an accounts payable. That's the terminology that we use.
Basically like a PO. Similar.
Exactly, like an invoice. Yeah. So once you get invoices, when you lose that cash, right? I remember when depending on how fast your purchasing system works, accounts payable. So this would increase, which is a credit on this side. So, and I'll teach you guys about this in a second, but this is a credit on liabilities as an increase. To increase a liability, it's a credit. All right? This will be increased by 100 because you're going to owe me this $100. And then guess what? When you give it to me, because you're a trustworthy person, right? You're going to give it to me the next day. You're going to reduce your accounts payable by $100, and you're going to and you're going to reduce your cash. because you're going to give me $100, right? And that's how it balances out. And remember, a reduction in liabilities is a debit. Remember that. So it's a tough, an increase in assets is a debit, and a decrease in assets is a credit. An increase in liabilities is a credit, and a decrease in liabilities is a debit. It's flipped. So that's why it balances. But we'll go into more examples because I know you guys are looking at me like, okay, that was a little difficult.
Usually either you work in one department or the other, but never actually like you're the in charge of everything, AR and AP.
Yeah.
So
Accounts receivable and accounts payable.
Yes, so I'm used to, I've worked both in AR and AP, so I'm like, and so I'm like, that's why I said, oh wait, the PO.
Yeah.
Is similar, okay, so PO would be your liability.
Yeah, yeah.
Okay, and then AR would be like when I do my billing, because I also worked in AR where we would bill out.
Yeah.
We were here.
So that's kind of how that works. I like that example because it gets you thinking of the snapshot in time, and it's when, and there's a terminology for this that I haven't described, that I haven't told you yet. It's called accrual-based accounting. Accrual-based accounting is basically all this means is that we're going to recognize these changes when it happens, right? So basically, even though I didn't collect the cash, I'm still recognizing the revenue, right? Or even though you didn't pay me the cash, you're still recognizing the liability because you're going to owe it to me, right? Makes sense? That's accrual-based accounting. Cash-based accounting is when the cash gets exchanged. That's how we all use our checking accounts and stuff, right? Everyone knows cash-based accounting. That's the easy one. Accrual-based accounting is a little bit more difficult to understand because of the fact that it's based on when the actions happen, not necessarily when the cash is received, which is what most people are used to. Make sense? All right. Any other examples of liabilities?
So I just kind of want to
Mm-hmm.
make sure I understand this. Okay, so you gave food to Inez, so Inez will, on her asset, she'll increase the debit by $100.
Yeah. So maybe I'll actually diagram it up here so that way you can see it. Debit. And this is credit. Good question. Stop me if I'm going too fast. People say I write my D's like I don't even know. I don't write my D's very well. Sorry. So that's a D. Okay. So you got debit and credit, right? So how this would work is because, she increased her assets by the phone, which is a value of $100, right? You got to increase your liabilities, which is a credit to increase your liabilities in accounts payable by $100. So it'd be $100 AP, which stands for accounts payable. So this would be an increase. And the reason it balances is because that's a debit of $100, and that's a credit. And the equation holds, right? Makes sense? All right, cool. So, any other examples of liabilities? Or you guys kind of figured this out? All right, great. Now let's talk about shareholder equity. Okay. So shareholder equity, if you recall, assets minus the liabilities. So now you understand what assets are, understand what liabilities are. So it's assets minus liabilities equals shareholder equity, okay? That's the value of the company, right? So what do you think are examples of shareholder equity? This might be a little harder.
The overall account.
What do you mean? Elaborate.
Okay, you have your assets and then you have your liability, and the outcome of those two things is what your shareholder equity would be.
Yeah. So what would be like a specific example of what would be in shareholder equity?
So would it be like, okay, say you have a company and they say our net worth is worth this,
Yeah, the cost.
Expenditures you have outside of that.
Exactly.
That's what your shareholder equity would be left over.
Yep, exactly. So like in the example that we talked about here, let me go back to this one, right? We said, weren't we selling ice cream or something? We said $100 worth of ice cream we sold, it cost us $10 to make it. The difference, remember, I said it would eventually go to shareholder equity. That's like basically the profit, right? So one example of what would go under shareholder equity is, we call it retained earnings. Another way of calling it is profit. So in this example that we had up there, the $90 would go here. It would go plus 90. Whoops. Sorry. Retained earnings are like that. Does that make sense? And it should balance, right? Because we got debit 100, credit 10, difference is 90, right?
Wouldn't that mean debit though? Because debit is what credit is what you owe?
No, that's not, and that's what most people, that's the intuitive way of thinking, right? This is rules. So remember, these are rules. So we're saying assets minus liabilities equals shareholder equity, right? And so with this kind of this equation, right? Any asset, right? To increase any asset, you have to debit it. To decrease any asset, you have to credit it. To increase liabilities, you credit it. To increase shareholder equity, you credit it. To decrease shareholder equity, you debit it. To decrease liabilities, you debit it. That's probably the one thing in accounting that most people get mixed up. For whatever reason, I figured it out pretty easily, and I was able to figure that out. But even my colleagues in classes that were in my class for months, it was still difficult. So I think most people find it difficult to kind of remember that. So, but yeah, that's how it works. I don't know how it's just the rule of how it works, and it makes the equation balance. Because if I would have put it here, it wouldn't balance anymore. All right. So any other questions about like shareholder equity? So retained earnings is an example of shareholder equity. What's another example of shareholder equity that maybe you guys can think of? So when you, I'll give you another example. So let's say everyone thinks our ice cream shop is doing pretty well, and you guys want to give us some money. You can either give us a loan, which would be a liability to us because we'd have to pay it back, or you can give us what? A donation. That's true. So that would probably go like retained earnings, or it could be a donate, or we could call it donations or gifts. I wasn't even thinking of that one. That's a good example. But there's another thing, which is kind of, so it's kind of basically, everyone knows what stock is, right? If I'm issuing stock, right, it's not a liability for me. I'm increasing my assets because I'm getting cash, but then I have to balance this equation with the credit. So I'm going to increase let's say I issue for the ice cream parlor. Let's say you give me $100, right? So I'll give you $100 of value of our company. I'll share some of the value, share some of the dividends of our company with you, right? So you give me the $100. I get to put $100 in cash in my assets, and then I get to increase my shareholder equity, right? Credit it by another $100, but it would be a credit of stock. So what we call it common stock. Okay? And that would increase by 100. So basically, that's another example of shareholder equity, of a way to essentially raise money without incurring a liability. So a lot of companies, big companies, Disney or whatever, whoever it is, right? They'll be like, we're going to issue more stock because they want more money, right? But they don't want to increase their liabilities. So what do? They issue more stock. And then people buy the stock, and then they get more money, and then they increase their shareholder equity. Make sense? All right.
Side question.
Yes.
What happens though if everyone wants to cash in on that stock?
You reduce it. Yeah, you have to exactly. Great question. So you'd have to reduce your when people cash in on it and no one else wants to buy it, right? That's where the stock value goes down. So that's the key is if you're selling it, you want to sell it for more or at least what you bought it at. If no one wants to buy it at that, the value goes down. So that $100 isn't worth $100. So my equity isn't as large, right? I'm losing money. But the companies like it because it's not a liability, but you're giving away some of your company at the same time. Make sense?
So when a company says they want it public, that's what they're doing there.
Oh yeah. It's basically a more liquid way to quickly issue stock. Instead of if you're a private company, I'd have to go like door to door and say, hey, would you like to buy some of my company and do a contract and all that. When you're a publicly traded company, right, you just go into NASDAQ or whatever, and you can issue your stock and raise money. Facebook did it, made a bunch of money, right? So that's how that works. All right, so we went through all three areas. That took a little bit of time, but I feel like you guys have a little bit better understanding of a balance sheet. Okay, great. So how do I go back to the PowerPoint? So do I do this over here? Like that? Okay. All right, so we did this video. Okay, so I have this kind of pretend company I created called Rush Hour. The only reason I came up with Rush Hour is I have a picture of Rush Hour in my office. And when I was building this, stuff, I was like, oh, maybe I'll call it Rush Hour. That's why. No other reason but that. But this company balance sheet is a pretty simple balance sheet for us to kind of get our feet wet with, right? So this is a snapshot of Rush Hour as a company, which I think I said I wanted them to sell. I can't remember what they're selling, but you'll see. I think they're selling cars, maybe. So as of June 30th, 2016, this is the snapshot of Rush Hour's balance sheet. What do you see on here that you have a question about? Or do you guys understand what these different areas are, what it's saying? Oh, good question. That's just equal, like cash equals 100,000. Yeah. Good question.
Are the non-current assets things that will be procured in the future, or is that?
Good question. So that's a terminology I didn't teach you. So non-current assets are pretty much assets that are more like long-term assets. It's not as liquid, right? It's not very easy to disappear. Goodwill supposedly is not as easy to disappear, right? Or a big, large capital equipment that you have. Those are more of like a long-term asset. That's why they call it non-current. All right. So kind of taking a look at this, do you think this company is doing pretty well? Or do you need more information? Or? Mm-hmm.
Their inventory is only 5,000, and their cash flow is 100,000. Yet their goodwill is what? It's
120,000.
Is 120,000. So they're according to their shareholder equity, they're doing good. But when you look at their current assets,
Mm-hmm. So that's good points. Those are great points. So you caught something, right? We put in goodwill. I purposely put that in. But we put in goodwill, $120,000, right? If you look at retained earnings, you're like, wow, $335,000. That's It's a lot of money, right? But when you start taking a deeper dive in things, right, you start to see, oh wow, accounts payable 65,000. Is that good or is that bad? I don't know. Well, they have cash in hand 100,000. That seems good. Accounts receivables 50% of their cash. Is that good or bad? I don't know, right? $55,000 accounts receivable. The inventory seems kind of low, 5,000. So it kind of tells you a little bit of information, but it doesn't tell you the whole story, right? It's like you almost want more information. It's almost like I have more questions than answers right now, right? So that's a rush hour balance sheet, and I don't know where I put the clicker. Oh, there it is. Okay, so we talked about this: assets minus liabilities equals shareholder equity, right? And remember all that great stuff you learned about balance sheets, because now we're going to talk about income statement, okay? So remember, those are the two things I wanted to talk about. So I'm going to jump into income statement, and you're going to see how the two kind of interconnect and tie.
The income statement is a report that measures a company's financial performance over a specific accounting period. This statement is also known by a number of other names: profit and loss statement and earnings statement. Publicly traded companies must produce income statements along with balance sheets and cash flow statements for each quarter and each year in accordance with generally accepted accounting principles. The income statement shows a company's revenue, expenses, and net profit from both operating and non-operating activities. It lists the company's net sales, cost of sales, gross income, selling, general and administrative expenses, special or extraordinary items, and other income and expenses, which then reveals the company's gross profit, operating profit, pre-tax profit, and after-tax profit. The income statement is divided into two parts: the operating and non-operating sections. The operating section shows the revenues and expenses associated with the company's regular business activities. In the non-operating section, the company reports any revenues or expenses not directly related to its regular operations, such as the sale of investments. Generally, investors look to the income statement in hopes of seeing an increase in revenue or net sales and a decrease in expenses. The less money a company has to spend and the more money it earns, the more profitable it is.
So this actually, I think explaining the income statement might be easier than the balance sheet, because the income statement is actually a lot more intuitive. What are some of the things you picked up from that video about the income statement that you thought was different than what you've been learning about the balance sheet?
It's more cut and dry, like income, expenses.
Mm-hmm.
One's plus, one's minus, and at the end you have
Mm-hmm. Yeah, exactly. It's more intuitive with what we're used to. Anything else? I'm looking for what I kind of started out with when I explained the difference between a balance sheet and an income statement. What's a major difference?
One is just a snapshot.
Good job. Over time, yeah, exactly. Exactly. So that was what I was looking for. So income statement is a measurement of a company's financial status or performance over a specific period of time, right? And so if you look at even your checking account, right, and you just said, okay, for the month of July, year to date, today's what, the 20th? Okay, so July 1st to July 20th, you could do your own income statement, right? You could look at how much you spent and how much money you received. Revenue, right, minus expenses. And then you add it up, and then you get either a negative number or a positive number. That's how simple income statement is, right? It's so much more simple than the balance sheet. So I have this example of the rush hour income statement. Books, that's what we sold, books. Okay, so rush hour sold $50,000 worth of books from July 1st to July 31st. So that's the interval of time, right, that we sold all these books. And our total revenue was 50,000. So basically all the revenue we received was from selling books, okay? Expenses, these are the expenses Rush Hour had. Cost of goods sold, $1,000. So we made the books for pretty cheap. So pretty good profit margin, right? Utilities expense, $1,500. Rent expense, $2,000. And total expenses, there should be a K there, $4,500. So if you add these two up and subtract it by total expenses, you get net income of $45,000.5. Make sense? This is probably super, I should have started with this, right? Like, this is super intuitive, right? Makes sense, okay. So how does this connect with the balance sheet, right? Because this is all interconnected, and if you notice, there's only one statement that I did not include that they said that every quarter publicly traded companies had to do, which was, anyone catch it? One statement. Exactly, yeah. And that's a very important statement, by the way, but I think it would have been too complicating to throw it in today. But the cash flow statement is another one, and I highly recommend if you're interested in this to, there's a videos I can maybe share with them, and she could post it on the Moodle.
On a lot of these basics is already on.
Oh, it's already, you already put it? Perfect, okay. So you can learn about the cash flow statement. But anyways, these statements actually interconnect, and it's very harmonious, right? Where it's like, it's so cool. If you were, like I was a grunt level employee, where I would literally like try to figure out where the penny was that was missing and stuff, and try to make sure all these different statements balance, and it felt so good when we figured it out, because it can balance, right? All these statements, the cash flow statement, which we're not learning about, but the balance sheet and income statement should all match, right? So how does this interplay? How does this interconnect? I'll give you guys a couple examples through these transactions, okay? These are going to be transactions, right? And this is where I want you guys to participate. So this is where you're going to be kind of doing the problems. Maybe you can write it on your paper if you guys have a piece of paper, and I might call on someone to come up and share with me how they would write this out. Let's do it on this space here. So, okay. So what we're gonna do here is there's gonna be different transactions that I'm gonna show on this slide, and I'm gonna ask you guys to kind of go ahead and try to work out the problem on the piece of paper. You can talk to your neighbor and ask for help or whatever, work together. And then I'm going to ask for a volunteer to come up and give me why they put the answer they put. So the transaction is this. 200 books were sold at a price of $50 each, okay, to John's Bookstore on July 2nd. All right? John's Bookstore pays you cash. Cost per book equals $1. What would the balance sheet transaction look like? And let me get a marker. So if someone wants to volunteer, we can. And what we're going to do is we're going to do it as the way I was doing the examples, right? The T. So 200 books were sold at a price of $50 each to John's Bookstore on July 2nd. John's Bookstore pays you cash, which is Rush Hour, our company cash, and the cost per book is $1. Can anyone help me figure out what the revenue is that Rush Hour should receive? Good. Great. So we know that revenue, I'm just going to put it as a note up here, is 10,000. Why is it 10,000? $200 what?
200 books times $50.
Okay. Just want to make sure I didn't hear plus. All right. Makes sense. So that's revenue. So where would that go on the balance sheet? Exactly. Perfect. So what do I do? All right. What else do I need to do? Buy what? Why? So right? Oh, whoops. I should have done it like this to keep it consistent. $1 book, right? Okay. So like that. So I need to credit this by what? I'm not going to do that. Okay. In where? Why liabilities? So as a debit, what kind of asset is this 10K? Perfect. And what kind of asset is the 200 that I deducted as a credit in my assets? Perfect. So we're still not balanced. How do we balance?
Equity, shareholder equity, we have a credit of 9,800.
Perfect. Good job. And why is that?
Because your assets with minus 200.
So how did you get 9,800? You subtracted what?
10,000 minus 200.
Does everyone get that? Oh, I did it again. You guys get the point. And what is this shareholder equity called? Yes, retained earnings. I'm just going to call it RE for short. Was that hard? Wasn't that simple? You can do that in your sleep. So that's the answer, and hopefully I have that same answer as my check answer. Or maybe I got it wrong. I think that's the answer. So debit the account cash, 10,000. Credit the account inventory, 200. And credit the account retained earnings, 9.8. Good job. You guys can give yourself a round of applause. That was decent. That's hard to do. So I'm going to do another one. Who wants to volunteer? Now we have one example down. 800 books were sold at a price of $50 each to Elsa's bookstore on July 5th. Elsa's bookstore will pay you your cash next month. All right. So no volunteers? I'm going to have to call on someone, or I'll let Emma call on someone. All right. All right. So let's walk through this again, like as a group. So 800 books were sold at a price of $50 each, right? To Elsa's bookstore on July 5th. So what's the total revenue? Let's erase this stuff here. 40,000. All right. Why? Okay, so I'm trusting your math. So we got 40,000 is the total revenue, and it's because what?
800 bucks times $50.
Oh, thank you. Times 50, right? Oh, whoops. Is it $800 or 800 books? Okay, 800 books times $50. Okay, right? So that's the revenue. Okay. So where does that go in the balance sheet? Debit under what? Why? Exactly. So right here, what am I going to put? $40K AR. Great. Good. This isn't that hard. So then what? What happens? We have 800 books were sold at a price of $50 each to Elsa's bookstore on July 5th. Elsa's bookstore will pay you your cash next month. So what else do I need to do? So there's 40,000 in accounts receivable. $800 as a loan. How come?
You're saying you're gonna pay him next month.
So 800 books were sold. So Rush Hour sold those books, right, to Elsa's bookstore for $50 each, right? So what we said initially is that we got the revenue at 40,000, but we didn't get the cash yet. So we said, hey, let's put it in accounts receivable because we believe Elsa's going to give us that money, right? So then, what do we do with those books? Inventory. Okay. How do we? Yeah. So what do we do with those books? How do we? All right. Credit 800. Yep. Good job. And what is it called? Yep. All right. So what else is going on now? How do we balance this thing? So let me put this math here. What did we say? Inventory is 800, but why? Perfect. All right, so now what's next? How do we balance this thing? Yeah, absolutely.
So that equals the same type of retained earning, you do it the same way?
Yeah.
You actually have the cash on it.
Exactly. We're not a cash. Remember, we're using accrual-based accounting, not cash-based accounting. So we don't need the cash to recognize the retained earnings.
Okay.
Make sense? That's why there's a whole statement called a cash flow statement. All right. So what do I do? How do I do it?
9,800 in credit.
40,000.
So what do I put here?
200.
Like this? That's the answer? All right, I'm trusting you. And this is what? Yep.
So the cash flow statement will show exactly where this cash is at this point in time.
Of course. That's why it's called a cash flow statement. That's why it's all kind of interconnected. So you're recognizing this revenue because the transaction happened. It happened, right? I got the books, or I sold the books. Rush Hour sold the books to Elsa. Elsa got the books. She's going to say a liability of an account payable of whatever, 40,000. I'm going to say accounts receivable of 40,000, right? Now, how did I calculate 39.2? Perfect. Good job. So let's see if my math was right, because I know this is right. What's this? Did I do that slightly off? I think it's a little off. Yeah, I probably just typo. Another typo. Let me just write that in. Okay, but you guys get how that works? Cool. Any questions so far? So those are 2 examples. We got a couple more. Okay. So here's another example. You're paid $1.5 thousand for your utilities bill for the month of July on July 14th. So you're paying a utilities bill. So you paid it with your cash. How would we write this out on the balance sheet?
With these earnings, it would be under, it'd be a credit under.
A credit?
I'm sorry, debit. Wait a minute, yeah, it would be, because it would be something we owe out. So it would be a credit, because we're just subtracting it from our profit. It's a liability,
So let's start off with the paid part. How do you pay? If I'm paying cash, what do I first need to do? 1.5 thousand, right?
To take it out of your asset.
Exactly. So how do I do that?
Credit.
And what kind of asset is it again? Yep. All right. So now how do I get it to balance, which I think what you're talking about. What? Debit, exactly. Because you're decreasing your liability, because now you've paid your payment. Remember, increasing liability is a credit, decreasing a liability is a debit. So that's 1.5. And we'll call it accounts payable, but you could call it other, things like a utilities, agreement or whatever. When you're looking at different accounting statements, and we'll take a look at the exactly CVHS, you'll see that they have different kind of terminology, but it's okay like that we're calling it accounts payable. The point is we're getting it in the right bucket here. Good job. All right. So debit account retained earnings. So I made a mistake there. It should be a liability here. So paid. So the next one is paid $2,000 for your rent bill for the month of July on July 18th. All right. So how would we do that? Paid $2,000 for your rent bill for the month of July. Put 2,000 under what? Yes. All right. And then what? Exactly. And it's the same type of thing. It's very similar to the other example. So we would do that here. Cool. So that's probably enough examples of these types of transactions. And so the next thing I wanna get into is the printout that Emma, I think, said is on the website. So maybe you guys can pull it up on your computers for the Central Valley Health Network, the balance sheet for Central Health. And this is, Emma, maybe if you can drive this, like scrolling up and down for me, and I'll use the pointer. So this is the balance sheet, and it's a snapshot for Central Valley Health Network at March 31st, 2016, right? So here we have current assets, okay? We have checking, Wells Fargo, They even put even the bank name, 352,000, right? And then we have another, it looks like a different separate account, Maffeo, 10,000. Investment, 22,000. Petty cash draw, 135. PayPal, 6,100. So all of these are under cash. Make sense? It's just they broke it out even more detailed, what kind of accounts of cash. And then total is down here. Now we have accounts receivable, right? Things that people owe us, IOUs, right? We have member contributions. What do you think that would be, member contributions?
It could be their actual, I don't want to say customers, I want to say if they're providing patient services, then that would be like all of their members that they have insured.
Yeah.
That they're providing services.
Perfect, exactly. And they make contributions into the plan, right? So they collect revenue, but it's like me, right? I get my paycheck gets deducted, every month, but it's not like I've paid the whole year today, right? So that's why the accounts receivable. Membership dues, right? It's kind of similar thing there. Business services, other. So this is all accounts receivable, $92,000. Now we go down to other current assets, grants receivable. So these are all the different grants, AmeriCorps, et cetera. So these are grants that probably are things that they won that they're going to receive money periodically throughout the year. But this is a receivable grant. They haven't received the whole grant yet. Make sense? So 87,000 in grants receivable. Then we have prepaid expenses. Isn't that interesting? You have an expense in an asset. Why is there an expense in an asset? You're kind of close. Anyone else want to take a shot? Prepaid expenses, and expenses is not an asset. Counterintuitive, right? Basically, the reason it's there is that they paid it already, right? They paid for an expense early, essentially. So it's kind of like if, we would never do this, but if we paid a year in advance, our mortgage for the year, we paid it all, It's a prepaid expense. I get to live in my house and I don't have to worry about, making those payments, and it's an asset. Yeah, you're paying it early.
Like AEP dues, we paid our AEP dues for our residents out of
Yeah.
grant funds. So
Yeah.
we have to account for it as an asset, even though it's not tangible.
Yeah.
That's right. Okay.
Yeah. So that's why it's in here, right? You got to account for everything, right? Deposits. And then we have fixed assets, right? Or non-current assets. These are things like the computers. Wow, there's a lot of computers there. Almost $500,000 worth of computers. Yeah. Furniture, fixtures, equipment, and then accumulated depreciation. So, these computers lose value quickly, right? $500,000 of depreciation in these computers. Furniture, depreciation, etc. Okay. I'm not going to get into depreciation, but basically, every asset has every long-term asset has a depreciation schedule of basically when it becomes not valuable anymore, right? Eventually, this iPhone is going to be not valuable. I'm going to depreciate it every year by $10, and you got to account for that because that asset isn't worth as much as it was in day one, right? Cool. Yeah, you depreciate. So that's why, even though it doesn't make sense, but when you buy a house and you rent it out and you fill out a schedule, I think it's C or something like that, I can't remember, you can depreciate the value of that house, even though the value usually, in good times anyways, it goes up. We own a rental house. So it goes up, but you're depreciating that asset on your books so you can get a write-off from the government, but the accounting works in the same way. That asset gets depreciated, even though you're going to sell it and it's not really that value. Yeah. All right, so that's the balance sheet. So let's scroll down. That's total assets, sorry, of the balance sheet. Now let's scroll down to liabilities. So here we have current liabilities, accounts payable. We talked about that. 21,000 bucks. That's not bad for how much cash they have and everything. Credit cards. That's a negative in here. So it's like they paid too much or something. So they have a negative 89.95. Very interesting. Other current liabilities, payroll liabilities. That's always a big one for companies and stuff like that. Deferred revenue. And other current liabilities, right? And then altogether it's 453, okay? And then equity. So who wants to do the math to make sure whoever their accountant is for CV did it right? It balances. Someone want to try to do that math, confirm it balances? So total liabilities and equity, $586,327.83. And then scroll up, Emma. Total assets, $586,327.83. Why do you think they combined the two, right? To make it easy for you to quickly balance. You can see it's the same exact amount, right? So it balances. The other thing I want to note, scroll down, Emma, right here, is you notice they call it net income. A lot of publicly traded companies calls this, shareholder equity section, and I use the word shareholder equity. They even just stated equity, which is what you said in the beginning, which is another terminology. It's the same thing, basically. Net income, retained earnings. You'll see in more publicly traded companies, stuff like that, they always call it retained earnings. Some people make it even more simple, call it net income, because most people understand what that means. So that's what that is, $50,745, right? At the end of the month of March 31st, that's how much net income they had within their shareholder equity. Any questions about this balance sheet? Make sense? Okay, cool. So now, why don't we click on profit loss? I want to take a quick look at that. I think it's that one, yeah, P&L. So this is whenever people use fancy acronyms and stuff, they go P&L or whatever. They say these things. All that is just profit and loss, right? That's just total revenue subtracted by expenses. That's what this is giving you a snapshot of for these accounting periods: October, November, December, blah, 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 all the way down to March, okay? So if you look, you could see the total income or revenue, and then you could see the expenses, and then you could see the profit. So scroll down, Emma. So you have it all in this statement, right? And then at the very, very bottom, I think they do the calculation for you, and you can see the net income here. So this gives you a sense of the transactions, if you will, that this health network had. All right. So what I'm going to do, does everyone, you were able to access this on your phone? Okay, cool. So this is how we got to kind of do this. We got to go back to the PowerPoint. I have one final question, and that'll be the last of our Starbucks. Oh, you do? Oh, okay, so then there's two. I'll make up a question after this. So it's not working. Can I hit can you do, if we do, there we go. You're just gonna have to advance for me. So go ahead and advance one. Okay, so we're gonna use the balance sheet from Central Valley Health Network. So we're gonna use an actual company's balance sheet. And I'm just making this up, it may have happened, may not have. Central Valley, we received $500 cash for membership dues on April 5th. Okay? We received $500 cash for membership dues on April 5th. All right?
So
What exactly? Where would that go? You debit assets with what? And what would you credit? Someone said it. I think I heard the answer.
It's under accounts receivable.
And what is it called? Perfect. So you you credit membership dues by the same amount because they created a membership dues as an accounts receivable. Make sense? So that's super intuitive. It makes a lot of sense now. If I would have explained this an hour ago, you'd probably be like, what is going on? So that's what we did April 5th, okay? Now, for the last Starbucks card, and I don't know what else Emma has, don't advance anymore. Just leave it at that. I want someone to tell me, huh?
If she got the question, you can give her that one and then this one more, right?
No, there's 2 questions. I want someone to tell me what the new cash account total will be for Central Valley Health Network after this transaction has happened. What will the new cash account be on the balance sheet? You're the accountant for Central, you're the new CFO, right? What would be the new cash account? CEO wants the new balance sheet, right? Trying to get investors to give him more money.
So the cash would increase by 500, 391, 933.
Uh-huh. So what's the exact answer?
391, 933, 03.
03? And how'd you get that?
Adding 100 to the total cash.
Cool. Does everyone understand that? Perfect. Cool. So my next question is, what will the new accounts receivable amount be? Mm-hmm. So what would the answer be? 92,170.31.
Oh, I'm sorry, 91,670.
Perfect. So Emma, she got it. Great job. So those are the 2 answers.
If you don't want them, we'll share. Trade me, because this is a good one. Still have one more question.
All right. So,
Did you do it?
yeah, I just did it. So that's the new accounts receivable total. That's the new cash account total, and it's balanced, right? We've balanced it. So that's how it pretty much works. As transactions happen throughout the year, throughout the month, you're constantly, if someone were to request a new balance sheet, that would be the snapshot, right? How does that interconnect with the income statement? Well, with the income statement, when I made those sales of the books, right, I sold $50,000 worth of books, and I collected this revenue, right? I did that sometime in the month of July 1st through July 31st. So there was a transaction that happened, remember, right, that where we collected that money, right? So the balance sheet gets shifted and changed. Retained earnings gets impacted as well. Expenses happen, right? Cost of goods sold, right? I'm paying other bills, etc. during that time in the month. All those transactions, right, interconnect with the balance sheet. So when we talk about paying utilities expense, when we talk about receiving membership dues, or when we talk about receiving cash for accounts receivable, those transactions happen during a period of time. Then the balance sheet gives you that snapshot of where things are at right now. Kind of like if I went to my Wells Fargo account, I would see how much I had in my checking, my savings, and my investment accounts. It's my snapshot. But then I can look at the transactions, if you will, or the time period of what made that up. Does that make sense? All right, cool. So that's the balance sheet, income statement lesson. And so how much time do we have now, Emma? Because there's one more part, which is the budget. That's it. All right. So we got a quick little video for the budget. And a budget is really simple. So the budget is just a plan for how you plan to use your money, right?
Having a budget is the difference between being financially responsible and flirting with financial peril. Deborah has made the wise decision to create a budget to organize her finances and prepare for any financial emergencies. Her first step is to determine her net income. The net income is how much money Deborah has left over at the end of the month. This amount is found by using the following equation. Total revenue minus total expenses equals net income. Deborah's revenue is all of the money that she makes in a month. This includes income sources like wages, bonuses, and investment income. Usually, these sources are consistent on a monthly basis. Deborah's expenses include all of her monthly bills, which are broken down into two categories: fixed expenses and variable expenses. Fixed expenses are the payments for bills that are the same every month, such as mortgage, insurance, car loans, cell phone, and cable bills. Deborah's variable expenses are the bills with different totals each month, such as entertainment, groceries, gas, and utilities. Deborah can now deduct her fixed and variable expenses from her revenue. If her revenue is higher than her expenses, she has net income. Deborah can use her net income to build an emergency savings account or invest in her retirement. If her expenses are greater than her revenue, Deborah has a net loss. Deborah must reduce her variable expenses to balance her budget, or she will need to find a way to reduce her fixed costs, such as downsizing her home. By tracking your total revenue and expenses, you can build a budget that quickly determines if you have money to invest or save, or if you're living beyond your means.
Okay, so this is what, what a good thing would be, right, is to have a plan for your money and so rather than kind of, trying to explain this all to you and how I would do it, I thought it would make sense for us to work through an example. And so what we said was, let's create our own budget, right? And let's pretend we, wrote a grant and we won this grant, and we win this grant for $1.5 million, a lot of money. And this could be real, this could be like a job you really do. So this could be realistic, right? You're awarded a grant for a 3-year grant for $1.5 million, so you're gonna get $500,000 a year for the next 3 years, right? To educate people in the Fresno community on breast cancer or heart disease prevention, right? And so you get this grant, right? And the goal of the grant is to do preventative types of work around heart disease, right? So what do you do next? How am I going to execute our goal, which is to educate people in the Fresno community on heart disease? How am I going to use that budget that they give me, that grant money, that $1.5 million, the $500,000 a year? What's the plan? What are the first things that you think make sense intuitively? And this isn't a trick question. This is just intuitive thinking about what you would do if you're the program director of this grant and implementation of this 3-year grant.
What's your area? What's your population? You're going to go ahead and
So you want to do some research? And who's going to do the research?
You have, that's what I'm saying. In order to find out who your research, you need to determine your resources in that area. So if it's hospitals, those are all going to be involved in your stakeholders.
Okay. So who's going to lead this research?
You have to hire people.
All right. So who do you think we would hire to start doing this kind of management of work? And would you say program manager? So that's one idea, hire a program manager to do this research? Local colleges, that's another idea. So like an intern or something, or a professor does it for free. So local universities, maybe get a professor or an intern to help you do it. All right. So that's the research piece to understand, you know, where the people are, what they need, their demographics, those types of things. That makes a lot of sense. What else would you need to do?
What's your marketing structure, all of that.
Mm-hmm. So marketing structure that interconnects somewhat to research, but what's your marketing outreach or effort? It would probably be based on the research that you get. So I'm just going to write here marketing / outreach. So do you think the same people can do that, or is this a different group of people that needs to do that? Or how are you going to execute that?
Since you're going to all these hospital and cardiac places, you'd have to discuss with them on doing surveys.
Mm-hmm.
What's the patient population or just in general.
Do you think these people can do it, or do you think you need to get another group to do it, or do you think you're going to outsource that and pay a vendor to help do that?
You would actually pay the people that you're utilizing. I guess they would be the hospitals.
So you'd outsource it, basically.
You'd have to outsource it to retain the data you need.
Is that the only way you can do this? Outsource services to, how else can you do it? Uh-huh.
Well, you can use the, like I said, you can use the internet. Databases
Mm-hmm.
that are already present.
Mm-hmm. But who would actually do the work of picking, I'm going to use, I'm going to market it on Facebook, right, or whatever. Like, who's going to own doing that, implementing that?
Well, you'll have the program manager and, a professor to really do the research, then maybe have another person, doing the marketing and outreach. So that way it's that way
Like-
we're not pulling managers to do
Yeah.
marketing when they should.
How much capacity does this group have, essentially? So you're thinking you need another person, like a outreach coordinator or a specialist or something? Yeah, that was her job. Okay. Anything else we need?
Budget for the resources.
Yes,
Identify what resources.
Mm-hmm.
Budget
So we got a budget for this. Are these full-time people? Are these part-time people?
I think varies where research and marketing full-time.
You're the program director. You got to make the decision. What do you think? You got $500,000 a year for the next 3 years. Are you going to make them part-time or full-time? Let's talk about the research people. Do they need to be part-time or full-time?
I think they should. I think the research people will be part-time, especially if you're utilizing university students. Their time is flexible. They have to be accounted for, but you'd have to document just like you would on the law book.
Okay. So you got everyone else agree, or do you think it should be more full-time, the research people?
Actually, it should be flipped. I think it should be full-time, and then depending on how quickly you want the information, depends if the outreach should be full-time or part-time.
Mm-hmm.
I think depending on how quick you want the statistics
Mm.
about how hard you want them to go out there and start getting some information.
Mm-hmm. Okay.
So I'll throw in here, remember our vocab from the beginning, strategic planning? That's what you have to be doing here, is strategically planning your whole 3 years. And what you're saying is if you want to do all this research, hit it hard in the first 6 months, you're hiring people full-time, and that's all you
Exactly. Good thinking. Exactly. So, we got a mix of options, right? It could be, hey, we got a grant, 6 months, we're going to do heavy research. They're going to work full time for 6 months, do heavy research, and then they're done. And they're going to hand it off to this outreach coordinator person who's going to do the outreach based on the research, right? We could do that. Or we could do a mix of things, right? A gentle handoff, right? And all that kind of stuff. Mm. Yeah, so maybe it's always constantly ongoing relooking. Yeah.
It depends on where you're gonna base your, where the money's coming from. If it's
Mhm.
an academic institution, whether it's or in a community institution like community downtown or a private industry,
Mm-hmm.
hospital. So those all have to be taken into factors, because generally when somebody writes for a grant, they're already an institution and they have the faculties.
Mm-hmm.
It's determining who the, gonna be the key players involved in that.
Yeah.
You have to first get them, and then from there you have your subcommittees, which would be the marketing and outreach, and your, and each
So-
person is responsible.
And so what you're describing is a little bit more of a nuance of in-kind kind of budget. I call it in-kind, right? Grants have it all the time. They always say in-kind. What does that mean? It's just a fancy way of saying you're going to do work for this grant and you're already paid by this company, right? But in-kind, whatever your salary is for that year, it's like basically that's how you're donating your time in kind, which is valuable because you're getting paid, right? So, do they need a space to work? So we need probably a facility or a room, something, right?
And that can be in kind as well.
Exactly. Okay. Do we need technology? Yeah. So we probably need some equipment and technology. What else do we need to get this thing for the going, this grant going, to do this work? You think you could pull this off? You got $1.5 million. They're going to give it to you. Here you go. Check. You're going to hire a program manager, right? You're going to hire a program manager that is doing what? Research. Okay. That's the focus, it sounds like. Then you're going to hire a marketing outreach person, an outreach specialist. And we're going to lease a space. But we're getting $500,000. Do you think we're within budget, what we're describing, or we're, outside the budget, or what are you guys thinking? How much do you think it'll cost to hire let's say a full-time program manager? How much do you think that'll cost that would do the research? With benefits?
With benefits.
$85,000 a year. Okay, so that might be right? I don't know. So $85K, okay, with bennies. Okay. What about an outreach coordinator?
I would say, yeah, well, I wouldn't say half that, I'd say more probably about 50,000 plus mileage, which the federal rate right now is like 55 cents a mile.
Okay. So what usually happens with grants? And what? Anyone? Use it or lose it. So we got 55,000. We got 85,000. How much do you think it'll cost to rent a room this size? I mean, they don't need a room this size probably if it's just two of them. So
But you got to think you're gonna have university students coming in now at times.
that's true.
Equipment.
That's true.
So you're gonna have to have more space. You're gonna have to think about the fact that you're gonna be paying the outsourced companies, or say your vendors, which will be
Mhm.
physicians' offices. You have to know, there's a lot more involved. You'll have to know what type of, what the diagnoses are. You have to know what kind of their preventive medicine they're providing to the patients. So all
But
of
would that be wrapped in the research?
Yeah, you'll have to consider pharmaceuticals, so you'll have to pay pharmaceutical companies to get their information. All of that stuff comes in.
So what kind of budget do you think it'll be for basically grabbing that data? like obtaining, you know, data. Will it eat up basically the half a million, you think?
It will in the sense that your outreach person's gonna have to wine and dine, so they're gonna have an expense account in order to obtain information, and I would think it is. It generally is.
Okay, so we got an expense account, right? So basically, we're going to pay this outreach coordinator $55,000, $85,000. How much do you think this is going to cost for the year? Room, facility.
At least 15.
For the year?
You're renting a space.
Okay, $15K for the year. Technology equipment.
I would say probably, depending upon the type of equipment you use, you'd be anywhere up to 50 to 100,000.
What are we buying? So maybe I think you're interconnecting the actual marketing budget, right? So like because you could have the marketing collateral and stuff like that outsourced and pay the vendor to create it for you, right? The brochures and the materials, the website. So let's just put marketing budget here.
Okay, so that'll be, you figure that at least.
So let's say 100, yep. So you got 100K here, and then you have obtaining the data, expense account. How much are you thinking this is?
For a year,
Yeah.
at least 25, I would say at least 25,000.
Okay. And then I don't know if we ever got to a technology equipment cost for the year.
I would do a quarter of it, just say a quarter of it, 25,000 too, because a lot of times you have to pay, if you're not gonna buy, all in one fancy,
Hmm.
you're gonna rent it from someone.
Yeah.
That way they can maintain.
Yeah, and then you're gonna need desks and chairs and all those fun things.
cameras and phone
Yeah.
systems,
So
sound systems.
someone have a calculator? Want to add this up?
305.
305,000. So use it or lose it, right?
But you haven't even paid your
Two more
local.
team members.
You haven't paid any of your interns or anything, which you generally do. but
You're gonna pay the interns?
There's, yeah, you would have to pay them, they're not gonna do the work for free.
Okay. So how much are you gonna pay them?
So you gotta, it just depends on what the going rate is.
Interns. So this is what you're gonna do, right? If you got this grant, these are the types of things you gotta investigate, right? Interns are usually pretty cheap. That's why they're an intern, right? They're a college student and they're working on their degree, so they're doing work that once they get their degree, they'll get paid a lot more to do, right? So generally speaking, interns make a lower amount. Sometimes you can get this to be pro bono work if it interconnects with the professor's research they're doing, right? So, you know, this is a tough number to estimate, right? You'd have to do some research. But let's just say it's 15,000, right? So even at 15,000, we still have a lot of money left over. Let me just put it this way. The reason I wanted to go through this exercise, it's actually kind of hard to do this. We can't do this in this short amount of time because there's a lot of research you want. There's a lot of questions we have, right? What you can do, though, is you can start to think like you are thinking, right? Is like, what are we trying to do, right? And there's different templates. There's different types of strategies you can do for it. I don't obviously have time to go through them. In business school, we use this thing called Porter's 5 forces, right? It sounds like a Star Wars thing or whatever, but it goes through an analysis to help you do these types of strategic thinking, and then you can start to figure out, well, what it is that I really need, right, to get to the end goals that I have. I have to do this constantly at our school district. Our big focus, you know, is improving our high school graduation rate. So a lot of work is going into what resources and investments we need in order to do that. And believe it or not, we're hiring psychologists and nurses, which make no sense, it sounds like why wouldn't you just hire more teachers, right? But it's because of data and analysis we're looking at, and we're figuring out that a lot of kids aren't coming to school because they have asthma. And why do they have asthma? Because they're not going to the doctor and doing preventative stuff. And why is that? Because it's hard for them to get to the doctor and all this stuff. So let's hire nurses. So our school district is hiring nurses, right? Which is kind of weird, but that's what we're doing. We're hiring I think 10 of them. And the whole idea is to get these kids to prevent them from missing school and coming to school, increasing attendance rate, thereby increasing graduation rate. And when you do this analysis with your research team, right, you may find that heart disease prevention, you know what, we need to hire a bunch of policy analysts to convince the city to create a whatever, or the school board to create a policy on curriculum to do heart disease prevention classes in the high school senior curriculum. And that's the best strategy. I don't know. But that's the kind of thing that this strategic planning allows you to do. So I think I'm going to close up because I think I'm well over. But thank you for your time. I hope you guys learned a little bit about income statements, balance sheets, and a little bit about budgets. But it was great meeting all of you.